So hi guys, welcome to our basic guide, or you can call it a boot camp for our ICT trading. So most people have been hating on ICT lately, like they have a lot of beef, but I just think that a tree with ripe mangoes is the one that gets stones thrown at it. So I just find these ICT concepts and what the guy does to be something special. So with no further ado, I think we shall start into this video. So I'm going to be teaching you everything you need to do about forex trading from scratch. So first and foremost, what we shall start with is market analysis. So in market analysis, we have three main types of market analysis. The major one, what most traders deal with, being technical analysis. Right here we have technical analysis. So technical analysis is where you're going to read, you're going to observe price action real time and form a certain model or adapt to a certain model and press the buttons or click the button to place a trade. And in technical analysis, as I said, you have like venturing into the charts and so on and so forth, like what you see on the internet and what traders do. So another thing, if you're going deep, another type of market analysis, there is what we call quantitative analysis. So for quantitative analysis, you're going to come, if I'm to do like something of this sort, if I'm to load out barchart.com, this is where you're going to be dealing with numbers to trade. Numbers, you're going to deal with the news and everything. So if I'm to come and do something of this sort, I think they will have to be showing us something. So this, you'll be like working with numbers, technicals and stuff. You have to be looking at, now this is a chart, but this is not like, if you go into gold, this is not the chart that is being forwarded to you. You have to, so this is a chart that is dealing with gold, not gold versus the US dollar. But my major interest, if I'm to trade gold as a future, I will be trading it as GC. I don't need to log into this. But if I'm to trade this as gold, now what brings me to this, for me to come to this, I'll be looking for insight for the next move that is about to happen in gold. Okay, actually look into what the large speculators are currently doing in the market, like to see the current orders that are being punched in the market. But this is something that I would call outdated way of trading, or something that someone wouldn't do for the type of trade that we do, which is not high frequency. So we just deal with what the market makers provide for us. So I don't think someone would need this. This is quantitative view, and this is just a little bit of it. There is a lot that comes to this, and this is a whole different course. So this is what is used at Wall Street and those other big institutions. That is quantitative analysis. And then we have what we call situational analysis. So situational analysis, this is what takes in fundamental trading, like where you're going to look at what happened and formulate what happened and record again and again for you to formulate a trade. So if suppose if I'm to refer to something, because we have two hours of trading. There is what we call electronic trading hours and there is what we call regular trading hours. So electronic trading hours, these are hours that are provided to traders like by the market makers. But for regular trading hours, these are the real hours that are traded on Wall Street. Like on Wall Street, the market opens up at 9:30 New York time. So that is when the regular trading hours open up. So if I'm switched to regular trading hours, you'll find that the charts are different. We shall venture deeper into that later. So if I'm to give reference of the situational analysis for the regular trading hours, if there is, I can give you one model. If you happen to see that the high that was formed on Friday is not as high as the high that was formed on Thursday, regular trading hours, remember, then on Monday or throughout the week, market will be chasing the low that was formed on Friday if the high of Friday is not higher than the high of Thursday. Now that is what we call situational analysis. Like your analysis is basing on something that recurred again and again. And for the news trading, how news traders would do it, they would be looking into the past news. So take an example of the non-farm payrolls. Someone is going to go and look back into the forecast, into what happened with the past NFP news, or use those like the price action of the news that happened before to trade the current chart. So that is situational analysis. So if we are to look into technical analysis, so technical analysis includes two things. Like you have to consider two things when you're going to trade technical analysis, when you're going to use technical analysis. This is a beginner guide for trading from zero if you know nothing. So this is technical analysis. For technical analysis, you have to incapacitate time. You have to add time to your trading. You have to add time, and then you have to also add time and price. Like price, you very well know I'm talking about price action. Then time, what's the time that we use? We trade in a time zone. Depending on any location, wherever you are, the time zone that you have to be trading in is the New York time zone. So if I come to my settings on TradingView and I go to more settings, if I go to symbol, you're going to look for time zone, and you're going to look for UTC -4. This is New York time. New York time is the time zone that we trade in. So whatever I'm to teach you will have to dwell around that time. So if you have your trading view to set to New York time, then you will have trouble. So now take an example. Where I am it is 9, and the current time in New York is 2 p.m. So that's the difference. So I have to work with that. You have to work with time, knowing that different things happen in the market at a specific time. Like whatever happens in the market is programmed to happen at a specific time. Like nothing happens randomly. That's why we say time and price. Like these two are the same, are almost one thing. That's why we say time and price. Like you cannot trade without time. Basically, if you're trading without the time thing, then what you're doing is called gambling. It is better you go to a casino and put your money there. So time and price, that is one thing. And after that, after looking into this, for price, we have what we call, for price action, what we do reading price action is what we call market structure. So whatever you're looking at in this when you're looking at price, whatever you're doing is incapacitated with market structure. Like it is about market structure. So market structure, like this is, I would say that this is the appearance of the market, whether bullish or bearish, like the overall appearance of the market, like the data that you are provided with. That is the structure of the market. That's what I call market structure. So in market structure, there are different types of things. There are what we call PDRAs, there is trends, there is inducements. So we shall be tackling one by one. We shall be going one by one. So I think what I would start with, if I'm to teach you market structure, we said the general appearance. So I cannot teach you the trends without you knowing what forms the trends. So what forms the trends are candles, like a candle. So a candle, I would say like this is the general appearance, or I would call it the representation of price of a given commodity. That's how I can say to you what a candle is. Like it would be the general appearance or the representation of price of a given commodity, like how price of a given commodity moves, whether going down or up. So suppose we have price of a shirt. I'm going to explain this. So this is a candle. If I'm to go to parts of a candle, I'll have these lines, these two lines. Actually, let me do. If I'm to have these lines, that line and that line, those are what we call wicks. Those are called wicks. Those are wicks. So what wicks are? Wicks represent where the price of a commodity reached at a certain time. So this wick shows that the price of this commodity reached that level at a given time. So I'll explain that further, but those are called wicks. And then this massive thing you see, the massive rectangle, that is what we call the body. That is what we call the body. That is a body. So that is basically what a candle is. It's a representation of price. Now if I'm to do something of this sort and bring it out to here, so if we are to look at this as something, let me make it bigger for you to see very well. I would want you to see it very clearly. I would want you to see it clearly. Wait a bit. So if this is a candle, we said it is the representation of the price of a commodity. Now if I'm to draw something of this sort and add the prices right there, if I'm to add the prices right there and continue with my explanation, this has to go back there. So if I'm to add the prices, and that is my candle. So what I said about the wicks, if I'm to explain one part by part, what I said about the wicks, that the wicks show that price of a commodity reached a certain price tag at a certain time. So this week was this candle. I used the green to represent a candle that is going higher, and I used the black. So if it looked something like this, that would be a candle that is going lower. So these wicks show that price of a commodity reached a certain price. So if this is a candle that is going higher, this wick would show me that the price of this commodity dropped to 2365.25 as a price level. This price dropped to that price and went to 23658.50, then went higher and reached 23667, then went higher to 23671.25 and again dropped and ended at 23. You look this side, look this side, look right there at the black line. If I put this line there, that means price reached 23667.50. So that those wicks show me where price reached at a certain time. And this 0.5, this is the 50% of the price of the commodity. So take an example. If this was to be a shirt, if this was a shirt, let me see, if this was price of a shirt, so for price of a shirt, if the initial price, because this candle has spots, if this is a candle that goes higher, this would be called a bullish candle. Now what makes this a bullish candle? These candles have where they start from. Now where they start from, right here for bullish candles, where they start from, so suppose this was the starting price here, this level that I'm going to draw, that line, and I'm to consider that blue line as the start of the candle. That would be called my open. Now that is what we call the open of the candle. We call that the open. And where the price of the candle stops is called the close. Now this, I think, if I'm to consider, okay, let me use that. Let's put it at the top. If I'm to use that as the close, that would be the closure where the market, where that candle stopped. Wait a bit, let me first purchase something here. So let me first finish right here. First wait a bit. Wait a bit. I don't want this stream to be too long. I don't want this stream to be too long. Yeah. So I think, let me see. Yeah, so I think we are back. So what was I talking about? So I was talking about the open and the close. So where the candle started is the open, and where it ended is the close. If this candle started right here and dropped lower, then went back up. This wick is what shows me that this candle reached here. Now what determines the closure of this candle? What I told you about, that you have to align time and price. So every candle goes for a specific period of time. There is a candle that goes for a day, there is a candle that goes for 1 minute, there are candles that go for seconds, 15 seconds, 30 seconds, 1 minute, 1 hour, depending on the time frame you're on, and we shall see that later. So if I'm to consider if what makes this a bullish candle is if the open is lower than the close. Now if I'm to have a bearish candle right here next to this, a bearish candle would have its open higher than its close. That's how you differentiate them. Where the bearish candle starts from is always higher than where the bullish candle starts from. Now you would consider this a vice versa. You would say this is a vice versa of the bullish candle. So where you see the close of the bullish candle is where the open of the bearish candle will be. Now if this is the open and this is the close, that means this is a bearish candle. That means that candle is going lower. Okay, so if this was the price of a chart, put this aside. Let me put this aside. You put that right there. If this was the price of a chart, okay, how a chart varied in price. Let me first put off some of these things. I think you have understood the open and close. So if this was the price of a chart, and I'm to divide how the price of the chart moved, and I'm having these levels, these prices, 23654 and 23658, 2366 and 2367, 2371. If you were to buy this chart, the price that you would want to buy it at, like the price that would be so conducive for you to buy it at, would be the lowest price. So if I say that there was a time where the price of the chart was at its lowest at 23654 and its highest as 2367, where would you want to buy it from? You would want to buy it when it is at its lowest or near to its lowest. You understand? So, and if I'm to sell it, I would want to sell it when it's to make profit. I would want to sell it at its highest price, at there, or at near to its highest price there, to make a profit. If this was the initial price of that chart, I would like to buy it when it goes below its initial price, and I would want to sell it when it's higher than its initial price. Now that's how these two terms come. That's where they come from. We have above the initial point, which we could consider as the 50% of the price of this chart, and we have below the 50% also, where we would want to consider. So above the 50% or above the initial price is called premium. That is when the price of the chart is at its premium, or it's at its highest. And then below the 50%, that's when the price of the chart is discounted and it is at discount. So those are the two terms. Now there I formulate a law for you, like that: we buy at discount and and sell at premium. So you will not be looking to buy any of this share as long as it is at premium, so that then you won't make any profit. You would want it to drop lower. You would want it to first drop lower, then you would buy it to make profit. If you're to sell this share, you would want it to go higher, and then you sell it to make profit. So that is it. And trading is mainly consisted of buying and selling, as all know. So that's what I would consider a candle. So you have to take note of this premium and the discount thing and this low. So I think that is it for our first video. You should try to get, that was a brief work of how the market moves and how it works. And the last thing I would want to say, the market is not gambling. Just take an example. We had, if we were in the medieval times, like before these computers came, how would you trade? Basically, if it were me, I would go to a bank, have my money, because I know they had the old, if money was there, if it was monetary back then, I think they would have where the value of the currency dropped and went higher or lower. So I would get my money, go sit on the bank, wait for the manager or someone else to say that now the price has dropped, and I would go in and buy that and buy more money and get more money. Then if they say that the market has skyrocketed, and go and sold my money. So that is basically what trading is all about, but computerized. So you would want to buy something, you would want to buy something when its price is low, and you would want to sell something when its price is high. So basically that is it. It's not all about gambling. That, and if you're to do something like that, that means you have factors that you're basing on to know that the price is going to go down or it's going to go up. So basically that is it. Thank you for listening. Thank you for your time. We'll meet in the next video.